David this morning talked about the restriction of tax relief. Now that is your high tax earner, payer, sorry, okay?
I'm on a very low salary.
How do you do that?
Expense everything.
You expense everything. So he manages his properties through his company, correct?
Yeah.
Okay. So his income is limited because he only needs an income to pay his bare essentials. Everything else is used as an expense through the company. So his car, petrol, car tax, insurance, mobile phone, internet, and then all that's left is what he really needs to pay his own personal mortgage, and he could actually rent the property from himself if he knew how to do it properly. So it's only what you physically take out of your business and put in your pocket and spend on yourself that is taxable. It's something that's completely fixable. And if I'm earning £60,000 a year through my limited company, all I have to do is change the way I spend. Bring myself down to 43,000 and spend the other 17,000 through the business. Now, if I need £60,000 to pay my mortgage and buy my toothpaste, etc., then I'm living in too big a house. There'll be a way, won't there, that we can adjust that. We can look at what the way you're having to draw that money out. Right now, right here, unless you make a profit or you show a profit of more than £43,000 a year, next year's event isn't going to affect you. So that's definitely not the end of the world. Removal of the 10% wear and tear. Now the reason why they've done this, and I've met plenty of delegates who do this, every year the accountant puts through the 10% wear and tear whether I spent any money on my property or not, and then I buy a new sofa and I put that through on my accounts as well, and I claim that back as well. So in fact I'm getting double bubble on my sofa. So rather than them having to police that, they've just scrapped it. Okay, so you've got 10% wear and tear on your gross rent. So you've got £700 wear and tear allowance against your profits. Yeah? So you've not got this anymore. What could you replace that with?
Actual expenses.
Your actual expenses. Because over the course of a period of time, we probably aren't losing anything, is my point. What we are stopping is the person who's claimed both. So the idea is I buy a carpet, it costs me £100, I deduct 10% every year, and then I've got my £100 back and I buy a new carpet, put a new carpet in. Yeah? Whereas what they're saying now, I spend £100 on a carpet, I put that down on my tax return and I get my tax relief against my £100. Now, it's the same. Where it's not the same is for the landlord who never spends a penny on their property. I don't think that's the end of the world, do you? If you're doing it properly, professionally, you're getting your money back at source when you spend it. The thing that I disagree with is their wording of the fact that I bought that carpet for 40 quid and when I replace it, I've got to replace it with a carpet of 40 quid.
Yeah, how is that going to work?
I don't know. I don't get that. I don't understand that terminology at all. And that's the way it's written. Because I can only claim back for a like-for-like replacement. Yeah. But for most of us, I don't think it's that big an issue. Then we've got this one, the 3% stamp duty issue. So the new law is a second property. So if you go out and buy your very first property to live in, this 3% has nothing to do with you at all. If you do rent to rent, 3% has nothing to do with you at all. If you own a property, you own your own home, you live in it, whatever, somebody else lives in it, you never go there, it's not got a bathroom, hasn't got a roof on it, I don't care what it is, it's classified as a property. Your second home, you buy a second home for £40,000, there's no stamp duty to pay. But if you're renting a house as a holiday let, it's not exempt. So you cannot use that as an excuse, even though there are people on the internet telling that you can. Okay? Which one will I buy?
The cheapy one.
Okay. So when we run out of cheapy ones, what's going to happen to the price of the cheapy ones? So what should we be buying?
Cheapy ones.
But if you want to make a short return, where should you buy? Because if you buy a £60,000 property, let's take it, it's 3%, 6 threes are 1,800 quid to buy that property. If a year from now it's worth 100, that 1,800 was a good...
It's worth it, yeah.
I believe this will make investors invest in areas that they haven't invested in before. That will then take up the housing stock, and I think one of the reasons the government are doing it is trying to shorten the north-south divide. If you buy 6 properties or more in one single transaction, it's classified, or you can choose, you don't have to, you can choose to do it as a commercial transaction. So if you buy a block of flats, and there's 12 flats in there, it's a commercial transaction if you choose to have that. Or you could choose to have the multiple purchase, so it's then divided like David did this morning. You divided it by what you've paid for the whole thing, and then that's the stamp duty calculation for each property. So if you were buying 2 each, in 3 separate names, which is what the guy that I met on Wednesday said that their consortium are doing, and their solicitor believes that they're not liable for the extra 3%, is that a way around it? So we're buying 6 properties, that makes it commercial. So it's a commercial stamp that moves into action, which hasn't got the 3% added to it. But there's 3 of us buying 2 each. But we're doing the same transaction on the same day. They believe that gets around it. They're just taking advantage of something the Inland Revenue haven't thought of yet. Personally, I would always buy through a limited company and only be buying 1 transaction. So as a for instance, I've got a limited company and I'd go and buy its first ever house. Does it have to pay this stamp duty? No, because it doesn't own any other property. If it goes and buys its second house, it will be liable for this. You can have this, so this be a group, this be a company, this be a company, and this be a company. This buy a house, this is an independent legal entity. This is an independent legal entity. This is an independent legal entity. You're the owner of the group owns all the other companies. This company will be buying property so they can rent it out. If you're buying property to fix it up and sell it, it's a different taxation class. Yeah. Massively different. So that's why you've got to explain what you're trying to do. Well, what you do have the ability is this one can lend this one money. This one can lend this one money. This one can lend this one money to buy the property. This one can pay interest back to this one and this one and this. Now, subject to what you're going to save, you've got to weigh up against the cost of a limited company. Because if it is going to cost you more in arrangement fee, valuation, interest, etc., or the lender says you have to do capital repayment and you don't want to do capital repayment, it might be cheaper to pay the stamp duty. So I think, as we go through this next year, there'll be all sorts of scenarios where you come up with where you go, my solicitor said I didn't have to pay it because of this. Because they won't have dotted all the I's and crossed all the T's. So they write to the Inland Revenue first, so we're going to do this next month. Is this okay? And the HMRC have a responsibility now to write back within 28 days with their answer. Yeah, in our opinion, we believe you are able to do that. They write back and say, no, don't do it. You've got to, obviously, all the time, you've got to make the calculation. So if you're going to buy via a limited company and you're going to pay 17% tax, or you buy as an individual and you're going to pay 40% tax, which are you going to do? You're going to buy it through the company. But if Barry then says, well, I can only get you a mortgage rate at 11%, so all I'm showing you is the headline. So each of you individually we've got to then look at you as personal, and it might be now down to transactional. It's not only just Bob is doing this transaction, and he can do the same thing for everyone he ever does. We might have to look at each transaction that Bob ever does in the future. So at the moment you get up to 21 months to pay your capital gains tax. Under the new legislation, which will be in by 2019, I think it is, that will be 1 month. So you'll sell your property today, they expect their tax within the month, which basically will mean your solicitor will collect and then pay it to the Inland Revenue on your behalf. You decide you want to be a buy-to-let investor. So out you go and you buy your first buy-to-let. That profit comes into you as an individual. And now for all sorts of reasons you're considering, could be that the tenant might sue me because they fall down the stairs, it could be because the tax man wants to take all my money, it could be that it's simpler for me to borrow via a limited company. So I set up an articles of memorandum, which is a legal entity in between me and the property. That legal entity is a legal entity in its own right. Even though I'm a shareholder, even though I'm a director, that limited company basically is responsible for what goes on here. Okay? So if somebody falls down the stairs here, they come and claim against this limited company. They don't claim against you. They can only strip away the limited liability protection if you can be seen to have done something illegal as a director. And you can take out insurance to protect yourself against that, which isn't very expensive. So if a judge decided you did something wrong and he's going to take away the limited liability protection, you can have an insurance against that, provided you haven't done anything wrong before you take out the insurance. So, problem with that. You buy your next house, and all the income and all your profits are coming into this limited company. Now someone falls down the stairs in this house and they sue this limited company. Whose profit is it? It's yours. And they're only doing it because now the limited company has some value in it. So what you do is you set up a tax-exempt UK company. The profits come into here, the expenses come all the way through here, and the profit, the actual value, ends up here. No inheritance tax. No CGT. It doesn't trade. So no corporation tax. So if you believe you have enough value in your world that you want to protect, this is the way to protect it. If you believe going forward you're going to build enough value in your life that you want to protect it, that's the cheapest way to do it. So if you start with nothing, this is cheap. If you join it with stuff, it's a percentage. I'm not trying to teach you this so you don't pay personal tax. I'm just trying to help you to understand that in a way this is a great way for inheritance tax planning. It's a fabulous way for capital gains tax planning. It won't get you around stamp duty, because the property is stamped, not the company. But it will help you with capital gains inheritance tax, and it will reduce you from having to be a 40% taxpayer to never being a 40% taxpayer. For any of you who are interested, or you think this might suit you better, then you need to book an appointment individually. You meet me, we discuss it doesn't cost you nothing. If I think it will help you, I'll then introduce you to the people who do it. That doesn't cost you anything. If you then listen to them and say, yes, please, I want to do it, they'll tell you how much it will cost you.